For more on Apple's earnings, let's bring in Fast Money friend Loup Ventures founder Gene Munster. So, Gene, what's your take on the quarter?
Melissa, my first reaction was I'm surprised that the guidance wasn't worse. And specifically is that they guided the high end of their guidance would suggest that it's in line with the street. Keep in mind, Apple does not want to miss 2 quarters in a row. So I thought that that was an impressive positive. The second is these other earnings have been coming in. The macro is impacting everyone, and Apple's doing a great job of navigating it. That said, it was a miss, and another piece to this is the earnings was more powerful than I expected. Typically, when companies miss their revenue, the earnings falls dramatically below plan, and in fact, they did deliver record earnings. And so, kind of putting this together, I think that explains kind of the reaction of the stock. One last more fundamental piece that really jumped out at me was the services growth, the margin growth in services year over year, going from 58 to 62%. I think that's comforting for investors because they're really putting a lot of weight in the services opportunity longer term.
True, and I think that's comforting, especially in an environment where it's expected that hardware margins will go down over time. But in terms of services as a percent of total revenues, Gene, is that growing to the point where you think it needs to be in order to keep people in the stock?
It's slow. It is growing to a point where it's clearly a topic where we are all focused on it. So I think that it is growing fast enough, 19% in the just reported quarter, in line with expectations. The point where it's a critical mass is probably 30%. It'll take us years to get there, but I think the trajectory and the profitability are very encouraging. This is also in face of some negative headlines around their services business, in particular Netflix and Spotify starting to drift away from using their payments platform. So I think that shows just the broader strength of the service offering and how the trajectory should be higher margins in the future.
Do you think that the root of Apple's China problem is in the U.S.-China trade war?
I think that has a measurable impact. I think that, it's obviously hit a lot of different companies, so there's probably more to it. If you're going to ask me to guess, I think probably a quarter of it is related to essentially some brand damage that's happened related to the trade war.
A quarter of Apple's China problem is a China trade war. So 75% of the problem in China would remain even if the trade talks resolved favorably.
Yes, I think that's kind of the China piece, and they haven't dived into it in the call. I think the China piece is going to take a year or so to work itself out. I think part of the China problem can be corrected relatively quickly on the trade side.